Hi, I'm Bill Blain, strategist with Shard Capital, normally based in London, but as you can see, working from home just like everybody else. We have some truly extraordinary situations in markets at the moment. We have seen a rally of unprecedented proportions over the last few days, and it's been stirred by two things. Partly, there are signs that the coronavirus epidemic may be close to peaking, but it's mainly on the back of the unlimited QE infinity that central banks are putting in place and all the promises of support that government is going to deliver to the damaged business sectors across the Western world. Now, as a result, the rally has really gotten completely out of proportion to where the underlying damage in the economy is. But is that a problem for markets? Well, maybe not. All that markets are doing is arbitraging the QE possibilities and grabbing the support that governments have offered. There are a number of major risks that will become apparent as that continues, mainly in terms of just how delinked global markets are getting from the underlying real economic situation. While markets are going that way, the global economy looks to be plunging off a cliff. And it's not just in terms of the obvious numbers, the ones we saw last week that now show nearly 10 million Americans have lost their jobs as a result of the containment of C-19. It's not just the slowdown that we're seeing across Europe, but it's also in the little things, little anecdotal stories that you're hearing from your friends who've been furloughed, or people that are taking salary cuts because they're not on furlough, but their businesses have lost half their income from people who are, and they need to keep the business going to serve the clients they have left. All these things have a cascade effect. It will be difficult for maybe a worker to pay their rent this month. That means that the landlord can't pay the mortgage on the buy-to-rent flat. That means that the bank then has to go and borrow more from the central bank simply to stay in shape. You have a cascading number of small pebbles starting to roll down the hill, and by the time we get to where we're going, you have an almighty landslide. Yet the markets are treating it as if the markets or as if the global economy is simply going to reopen untouched as soon as the lockdown finishes. Well, let's have a little bit of a think about what we're seeing from the virus perspective. When is the global lockdown of economies going to finish? Well, sadly, it isn't going to be anytime soon. We have seen estimates from a number of investment banks who think that economies like the UK and the US might see the end of lockdown later in April, with full markets reopening by the middle of May. Well, that may or may not happen, but it would require a massive shift in government thinking to occur, and that would be a move away from what we're currently seeing in terms of maximum social distancing towards taking more risk in terms of allowing people to go back to work and such things. And what do I mean by taking more risk? Well, it's really the risk of a second wave of infections, again threatening to swamp national health services. People also talk about the possibility of a vaccine, but let's not kid ourselves. If we get a vaccine within a year to 18 months, we will have been extraordinarily lucky to have done so. It's far more likely that new treatments, identifying the right drugs, but also new innovations in the emergency care units, such as breathing machines and simple ways of keeping kidneys going, will greatly reduce the damage that the virus does to individuals. It's going to take longer for the global economy to reopen than the markets seem to think. The second thing is the amount of damage that has been done to the global economy. And that's obvious. All you need to do is look at sectors such as travel, tourism, aviation, almost completely finished, not just for the next few months, but into the foreseeable future, by which I mean I don't expect to be going on a ski holiday next year because this will still be in place. I don't expect to be doing any business travel for at least a year and possibly longer, and it's going to be a long time before we see tourism restart. I was fascinated last week to see Carnival Cruises being able to launch a $6.5 billion bond issue secured on the back of their fleet of cruise liners. They had to pay 11.5% to do so, but the security, well, who's going to use cruise liners if this continues longer? Perhaps it's a good bet, perhaps it's a dangerous one, but we're seeing around the globe an increasing number of corporates desperately trying to raise cash to cover the long periods they expect to be shuttered. We're also hearing anecdotal evidence that the policies that governments have put in place to try and support businesses through this crisis are taking longer and are more difficult to deliver. Policy deliverability is going to be one of the issues that could cause the facade to crack. If we do see a cascade of defaults based on individual defaults because they haven't been able to access funds, social security, employment insurance, furloughed salaries, whatever, that is going to cause doubts within markets. At the moment, the markets are very, very happy to take all the QE that they can. And that's a very important factor because I always say that in bond markets you will find the truth. And at the moment, the ECB and the Federal Reserve are buying all investment grade bond issues. That's great news. Investors are piling into them because they expect that spreads will start to tighten again, because you're going to have very low interest rates for many years going forward. Therefore, you will move up the risk curve to get the better return from corporate bonds. But we also have about a third of the bond market is in triple B rated securities. Triple B are one notch up from junk. And the QE programs don't buy junk yet. I expect that sometime soon that will change and you will see central banks buying junk. Why? Because if high yield companies start to default, that will be another supply shock for the economy. The economy is already suffering from a massive supply shock. It doesn't need a second. And the bigger issue is the demand shock that would occur if even more people end up unemployed because corporates are defaulting. Central banks have put themselves into a position where they have no alternative but to continue. And that raises a very interesting problem. How much the financial asset world is becoming detached from the real economy. We are seeing real stress in the real economy, yet stock markets are staging spectacular rallies and bond markets are tightening. I don't think that's what governments set out to do when they tried to save the global economy.